Hello everybody, and welcome to this weekly update entitled The 10 Best Stocks in My Portfolio. So the goal of this video is to simply update you on the valuation of all 10 of these stocks. And if you've already seen the video, feel free to just take a screenshot and look at these valuations and what you think, keeping in mind that I am a hyper-growth investor, and thus I value stocks very differently, right? I value stocks based on how much am I paying for each percentage point of growth has seen through the lens of the enterprise value over gross profit over revenue growth metric. And really the goal is to buy when it's as green as you can, right? The lower it is on this metric, the more you want to buy, because you're paying very little for each percentage point of growth. You know, for example, if you take a stock like Hims, that growth, each 1% point of revenue growth, you're only paying 0.07. And if you look at, say, a stock like Palantir, you're paying up for a Palantir growth quite a lot more than you are for, say, Hims. In other words, the market gives no credit to a company like Hims and the future growth of Hims, but the market gives a lot of credit to the future growth that is built in within Palantir. And this valuation does not mean it's the stock that's going to perform the best in the long run, because a stock can stay with a high valuation for a very long time, but it really helps me time my weekly buys. And I tend to buy stocks every week. You know, every month I have an allocation that I want to put in the market, and every week I buy stocks, and I kind of use these to gauge which is the expensive stock, which is the cheap stock. So if you're new to the channel, let me go through my slides and tell you how I do things around here. So let's get started. So first of all, what I try to achieve on this channel is 30% nominal return, because if I achieve a 30% nominal return, that's the only way, in my view, that I can achieve a 15% real return. And if one were to achieve, say, a 15% nominal return, like, say, investing in big tech, in the NASDAQ, right, the Google and Apples of the world, you've had about, between 15 and 20% return each year. Really, in my view, the real return for that is a 0%, because the wealth is getting diluted through monetary printing. There's more dollars each year, right? And I estimate that to be about 15% more dollars each year. If the stock that you own is not grabbing 15% more dollars each year, it is drowning. Simple as that, right? The revenue should grow at least at the same pace as the money supply for your stock to theoretically just stay afloat. And that's why I really don't have a choice but to buy hyper growth stocks. That's the only way. So why hyper growth? I have no choice, right? And really, in order to do that, what I do is I'm stuck with innovation, because most of these stocks are going to be innovative companies, right? Most of the stocks that grow at 30% more each year are going to be innovative companies, and they're namely going to be in the early days of product adoption. So traditional metrics like price to earnings ratio or even price to cash flow really don't make sense, because the type of investing that I do is I try to find companies that sell products or services that are just getting started, that are very, very, very early on. And we know from data from hundreds of innovations that a typical innovation starts at about 5% adoption, right? And then it grows until everybody has adopted the product, 70 to 80%. And ideally, once a stock that I own sells a service to 70 or 80% of the population, I want to be out of that stock and move on to the next new thing. So, in a nutshell, this can be summarized as investing in the very, very long-term, mostly technological trends. This is the famous S curve, right, of technological adoption. Technological adoption always happens slow at first, and then suddenly. You really want to own the stock when it's just about to hit that then suddenly part. And many of these stocks, in my view, are beginning to be adopted suddenly, right? Tesla, Enphase, that's the solar roofs, right? Bitcoin, all of these stocks are getting adopted very quickly. So let me just go ahead and tell you about each of the stocks in my portfolio and the position ranking. So the first stock in my portfolio, and this has been the case for a while, is Tesla. Tesla is my first stock. Of course, Tesla is a little expensive right now in my valuation spreadsheet. Why is it a little expensive? Because everybody recognizes the Tesla opportunity. Tesla is not a secret anymore, if that makes any sense. And why would you want to invest in Tesla? Because they are revolutionizing the world of cars. Tesla are a bunch of 10x improvements stacked on top of each other, right? Costs about 10 times cheaper to drive, right? You don't have to go to the gas station anymore. That's about 10 times better, right? Or that's even more than that if you go to the gas station like every 2 days. Imagine just going home, charging at home, never having to waste time at the gas station. How much better is that? The car will drive itself eventually. How much better is that, right? How is it 10 times better, a car that drives itself, or is it 100 times better? I can't tell. But if with Tesla you stack all of these 0 to 1 moves are stacked in one company, and I didn't even mention that of course Tesla is more than just the electric cars, right? It is a mini Standard Oil with different businesses, right? It doesn't just have the electric cars; it also has a quote unquote gas station network, i.e. a charging network, the largest in the world, right? That could be a separate company. It has an energy division. That could be a separate company. It has an AI division, could be a separate company. This is the company that stacks S-curves on top of S-curves, and I am very confident owning this stock for at least the next 10 years, if not more. And if you look at the long-term returns of Tesla, of course, we've had 53% nominal return, which means that the real return, in my view, is almost 40% real return, right? 38.3% real return. That's an outstanding return. No matter how you look at it, they have more than captured their fair share of newly issued money supply. Let me now move on to Enphase. Enphase is my third biggest position if you include Bitcoin, and if you exclude Bitcoin, it's my second biggest position. Why do I love Enphase? Enphase is all about residential solar. In my view of the world, every single individual home out there, single family residence, they're all going to have solar panels on their roof just because it makes sense. I mean, the material is cheaper than roofing anyways. So why not put solar instead of putting a roof? That makes a lot of sense in my mind. And of course, if all roofs had solar, all systems would be oversized, such that you would be producing more energy than you even need for your home. And then you can use this excess energy for just about anything you want, including reselling it to the grid. But you can also be certain that in the winter you have an oversized system that's going to meet your needs, right? In the winter, shorter days. What does that mean to have shorter days? That means that you need to have an oversized system. So your system essentially needs to be designed for the 2 worst weeks out of the year, and the rest of the year you have excess energy. This is why I believe in the solar proposition, and why do I pick Enphase as my solar play? Because Enphase is essentially a duopoly with Solar Edge in the individual solar space, right? In the individual home solar space, they're essentially a monopoly. Right now, adoption in the US is about 4%. It's at about 10% in the EU. We're early. If my view of solar, where we get to a point where 90% of the homes have solar, if that manifests itself 10 years from now, these are companies that are just going to grow exponentially, in my view, and I also believe that Enphase has the technically superior solution, in my humble opinion, for multiple reasons. But, for example, an AC coupled system, which is what Enphase has, is much safer than, say, a DC coupled system, where you can quickly go really high in 600, 700 volts that goes through your house. That's just one example. Shut off at the level of the panel, right? It gets shut off if there's any issue at the level of the panel, not at the level of an inverter, which is likely in your garage. Anyways, there's lots of reasons. I've done a full analysis on Enphase where I talk about my full thesis for an hour and a half. If you haven't watched it, you may want to consider it. Let me move on to HIMSS. So why do I invest in HIMSS? HIMSS, I believe, is simply healthcare. It's a company that's inventing healthcare, because in my view of the world right now, we have sick care, right? We don't treat heart disease when people are in their late 20s showing early signs of heart disease. No, we treat heart disease when people are in their early 60s, and it's going to be an expensive procedure. And it's going to be almost too late. HIMSS is trying to change that by having a youthful focus on young people and really catching early major health issues. That is the vision of the company. The company is often dismissed as a company that just sells ED drugs and other frivolous products, but this is the market dismissing it. This is not the vision. And if you listen to the call, if you study this company, their vision is much bigger. Their vision, in my view, the way I define it, is creating a preventative healthcare company that really starts before you even call your health insurance to pay for sick care. Right, because early on, people, I believe, are going to invest in their health, and HIMSS, I think, as a pole position to potentially become a disruptor of the traditional hospital and health system and of the insurance system. And I am very bullish on HIMSS. The growth on HIMSS doesn't cease to amaze, right? And it's a company that has actually beat its guidance multiple times and raised its guidance on numerous occasions. Very confident about this stock. Also noteworthy to say it's the cheapest stock. It's one of the cheapest stocks with StoneCo in my top 10 stocks video. Moving on to Palantir. So Palantir is the most expensive stock that I own here. Palantir is a little bit overhyped. I mean, I don't want to say overhyped. AI is very meaningful. But the stock is a little more valued right now because a lot of people are realizing that what Palantir has with its AI solution for the military is extremely special. And they're also realizing that using that same AI for commercial operations of various businesses, that's also going to be extremely special. And so the market is realizing that, which is why the stock is a little more expensive right now. Doesn't change the fact that over the years, the CEO has guided over the next decade a 30% growth in revenue. So in that case, that really, I mean, the price you pay matters in the short run, but in the long run, that typically matters less for a stock that is able to compound revenues at such a fast pace. It helps too to realize that the founder of Palantir is Peter Thiel. Peter Thiel is the co-founder of PayPal, right, along with Elon Musk, and they're part of this quote-unquote PayPal mafia, which are those people who have invented this concept of a 0 to 1 move, of a 10x move. This concept that if a product is 10 times better than the competition, then monopoly is what is going to ensue, because everybody wants to buy a product that it's 10 times better. That's the whole essence of 0 to 1. Everybody wants to get into that step change in technology, right? Companies compete against each other for products that are, like, say, 15% better, 30% better. That's incremental, right? That's competition, that's marketing, that's day-to-day. When a product is 10 times better, people have no choice but to switch, right? That's the reason why I'm so bullish on Tesla. $7 of electricity for 350 to 400 miles. You can't beat that. You're at $70 if you put gas. It's 10 times cheaper. Doesn't matter if people hate the car or hate the technology or hate Elon Musk. It's 10 times cheaper. People are compelled to switch. That's the same story behind Palantir and behind the AI of Palantir, even though the company relative to 3 months ago is a little more expensive right now. Let me move on to Crowdstrike. So why do I like Crowdstrike? 35% revenue growth. They gave us guidance 3 years out, $5 billion in ARR, which should equal to 35% over 3 years. Crowdstrike is an endpoint security system, i.e., I kind of call this an antivirus, even though I know it's a little different, but it's an antivirus that you have on your edge devices, your laptops, your phones, your cars, whatever is at the edge of your network. Whenever a virus infects one of the units at the edge, right, one of the devices gets infected by the virus, the cloud security software of Crowdstrike, cloud-based, the name of the software is Falcon, security system, detects the breach and broadcasts the breach to the entire network. And so the entire network knows first. So if you're from Crowdstrike, you benefit from the advantage of knowing that a device has been compromised somewhere on the other side of the world. And you get updated in real time, and you can stop that threat. So it essentially makes the job of hackers a one-time thing. Because it updates. And that's why I believe they will win, because they have the most data in that case, right? It's this company that has the most data wins. So this is an example of a winner-take-most market, in my view, and I am very bullish on Crowdstrike. Let me move on to MercadoLibre. MercadoLibre, in my view, is like buying Amazon or Alibaba in 2007, essentially. E-commerce adoption is not as big right now in Latin America as it is in the US or in Europe, and thus they have a big avenue for growth, a larger avenue for growth. MercadoLibre is a marketplace. It is a platform where buyers and sellers meet. They also sell their own products. They also have a fintech division. So a good way to think of it is kind of an Amazon without the cloud, but with fintech. And they've displayed amazing growth. They just reported their earnings yesterday, actually, and the growth was amazing and stunned everybody. And it looks like in an instant, if you look at the instant right now, they're closer to 60% revenue growth, which is amazing. I made a video about MercadoLibre yesterday. But anyways, if you look at the annual returns of the past 13 years, been 27% after the recent crash we've had. If you go back to before the crash, we're at 35%. This is well above my minimum revenue growth goals for our company. This is well above that, and I believe this is a company that has at least 5 years of runway ahead of it. Let me move on to StoneCo. So what is StoneCo? StoneCo, in my view, is like buying Square in 2014 for pennies on the dollar. That's the only way I can define it. Brazil is still going through this shift in digital payments, where, of course, nowadays digital payments are made through a payment device or through an app, right? StoneCo has an app too, where you can just pay with your credit card. And again, Latin America is also earlier on than, say, the US, who was kind of a pioneer in those systems, and companies like StoneCo and like PagSeguro are growing very, very fast. I typically try to pick the best stock when I have a duopoly, when faced with a duopoly. I believe StoneCo is a better player in this duopoly than PagSeguro. PagSeguro is kind of a legacy company, older tech firm. StoneCo is a newer tech firm, newer foundation, and I believe they have a little bit of an edge. But again, this is a quasi-duopoly, so tough to fault anybody. And whether it's for owning PagSeguro, if one wanted, like if one could own PagSeguro and StoneCo, I would understand that and even back that portfolio. Same is true for Enphase. I prefer Enphase because I believe microinverters have a better technology, but one could also buy SolarEdge. It's a duopoly. This is sort of a duopoly as well. Impressive stock, impressive growth. Extremely cheap stock, still flying under the radar. Then we have Nubank. So Nubank is a neobank in Latin America. They have little competition because, of course, legacy banks in places like Mexico and Brazil, they are, they're common, but the adoption of legacy banks is not as high in Latin America. And thus, Nubank is going after fully induced demand, i.e. new demand for banking products. You have people who never go through legacy banks, who just start banking with the app. And that's what Nubank does. I believe Nubank is going to have explosive growth in Latin America. And I own Nubank, say, over SoFi because I view Nubank's growth as even more explosive than SoFi, and I'm a growth investor. But I'm very positive about Nubank. This company has an amazing net promoter score, for example, for a bank. Customers love the company. There's a lot going for this company, and it is not that expensive right now, as fintechs tend to be in general. If you look at most fintechs right now, they're pretty cheap, if you ask me. Airbnb. Airbnb is a cheap stock. Airbnb is an interesting stock because it could fit both the goals of value investors and growth investors, which is why Cathie Wood and Warren Buffett both own Airbnb. Airbnb is often seen as this disruptor of a hotel. I think that's missing the point. Obviously, hotels are getting heavily disrupted by Airbnb. There is no doubt, but the vision of Airbnb is bigger. They are trying to create these two-sided platforms where people with spaces available meet people who want to occupy these spaces, period. And what that means, if you define it this broadly, that means that they're going after mom-and-pop renters and mom-and-pop rental businesses, right? Your traditional real estate investor who rents on his or her own house, they're tempted heavily to just list that house on Airbnb and go for Airbnb because Airbnb adds a layer of trust, a layer of protection, right? You have insurance. If somebody has a giant party at your house, Airbnb has $1 million insurance that protects you. You also have ratings, right? The people who have lived on Airbnb or used Airbnbs a lot have been rated a lot, and thus they have a lot of ratings, and thus you're more likely to rent a house to them because you see those past ratings and that you see that other Airbnbers, right, have had good experiences. So it really adds a layer of trust on an otherwise system of rental that did not have trust, and that whenever there was an issue, say, relied on a slow legal system, right? I mean, if you've ever tried to get an eviction, it's not easy in most countries to get an eviction. Not at all easy. And Airbnb is trying to address that. Of course, right now, the main business is the disruption of hotels, and so most people are focused on that. But I think the Airbnb value proposition is much bigger, and I'm very happy to own Airbnb. And lastly, my 10th position, which I'm putting Microstrategy here, which is a stock that has a Bitcoin treasury that invests in cash flow in Bitcoin, right? This stock doesn't pay dividends, doesn't buy back its stocks. It just makes money for its software. Sells a software, a business intelligence software, and the money that it makes, those cash flows, are invested into Bitcoin. So much so that this is a stock that's mostly trading today based on how much Bitcoin then they own, and not based on the underlying business. And of course, Bitcoin has been one of the most important investment of the past decade. If you go back 8 years back, if you look at Bitcoin. Actually, this chart stops after 5 years for some reason, but that's a 78% ARR that you would have had with Bitcoin compared to. So it's actually above Tesla. Like the return has been higher than Tesla, which is stunning. Which is stunning to me. Bitcoin is a story of network effects. It's a story of adoption. It's a story of 0 to 1. A better money with better features of money. And so the question is it 1 order of magnitude better? Is it 2 orders of magnitude, 3 orders of magnitude better? Could be, right? Could be. This is a money that cannot be debased. And of course, my channel being named Beat the Denominator, I do want to tell my viewers about a money that can't be debased, which is Bitcoin. So Bitcoin is insurance against things that could happen to the US dollar. And we saw yesterday the US debt getting downgraded. So if the dollar goes to zero because new dollars get issued, because the only way to get out of debt is to create more debt, right? The way to get out of a mountain of debt is to create an even bigger mountain of debt. And then the dollar gets lost within a bigger pool of dollars. That can't happen for Bitcoin because Bitcoin cannot be created. Its supply is fixed. And no matter the price of Bitcoin, you can't have someone go mine more Bitcoin like you have for gold. Ever thought about what it would mean if you had a $5,000 an ounce gold? What that would mean is that instead of finding 2 to 3% more gold each year, gold miners would find 5 to 6% more gold all of a sudden because they would have a crazy incentive to dig more gold out of the ground. That's the same story for oil. Why can't you invest in oil? I mean, you can, but why do commodities not make that much money? Really, that's because if oil gets to $150 a barrel, right, all of a sudden you have a lot of oil fields that were not profitable that all of a sudden become profitable and come online and supply the oil on the market. So Bitcoin is money that is not a commodity, which is an amazing innovation. It's money as free speech. It's money as code, not money as a commodity, not money as trust, but money as code. And I really believe in this technology. This technology is getting adopted. It is on the cusp of adoption. More and more people are buying Bitcoin. And so this finishes my video. This is not investment advice. This is just entertainment. I hope you were entertained. Appreciate your likes. Appreciate your subscriptions. Appreciate those of you who follow me on Twitter. Thanks for that. Or on X. I guess I should update that. Have a wonderful day.